As we were saying, Gonzalo Cañete, Head of Global Market Strategies for ATFX Connect. How are you? Good afternoon, Gonzalo. Tell us about the reading of this data. It seems to be better than expected. It seems to have an effect on the market. An opposite effect on the markets, isn't it? We see, for example, the S&P futures falling. Tell us a little bit about it. How is the reading of this data? And above all, how it may affect both the markets and the movements of the Federal Reserve?
Well, there are several issues. The first one is a positive data because everything that means an increase in prices in industrial activity makes things easier for us. That is to say, in this case, this data was more frightening if it came out negative than if it came out positive, because what we have seen recently, not only in the case of the United States, we have also seen it in the case of the German economy. We have seen it for 10 consecutive months since 2023 in the Chinese economy. Negative PPIs are a prelude to economic deceleration, to contraction of industrial activity, and basically they brought us or put deflationary risks on the table. Deflationary risks mean that not only do we not have an inflation problem, which is bad in itself, and we have explained it many times, inflation, what it ends up doing is to eat or recover the purchasing power of our money. That is, it eliminates value in our money. But deflation, what it does is, so to speak, to destroy the economic structure, because what we are seeing in the case of deflation is that activity on the supply side begins to slow down, and this ends up translating into, well, on the demand side, there is less propensity to consume, and on the supply side, there is less propensity to produce because prices are falling, which is what is reflected in a fall in supply. In this case, this data is positive because it indicates that we are not entering recessionary or depressive territory in terms of the economy, but it still worries the market because at the end of the day, it is a data that tells us that inflation is not something that is going to disappear at the moment. That is, negative PPI data meant lower inflation, even deflationary risks. That is positive on the one hand because it would mean more stimulus from the Federal Reserve, which is where you wanted to go, Sergio. What is the position of the Federal Reserve with all this? Negative PPIs would invite to quickly cut rates. Positive or strong PPIs would indicate that economic activity continues to be sustainable, and therefore there is no rush to cut those interest rates, which is what Wall Street does not want to hear. And once again, what the audience has to understand is that the positive data for the U.S. economy are not exactly positive for the U.S. stock market, which wants a crisis so that the stimulus can come in now, so that more dope, more liquidity can enter the market.
Precisely, Gonzalo. Along these lines, we see that the Fed's strongest members are already beginning, precisely as you were saying, to assign lower probabilities that there will be cuts in May, even in June, and above all, they seem to be pointing perhaps to this June meeting. They say that they could postpone the first cut even until after the June meeting, of course, as you were saying, just what the market does not want to hear in June, right?
Exactly. You see that we were also counting on the fact that a few months ago, there was possible rate cuts during the year from the inflation data we saw in the last US publication of an extremely bullish data. We see that this is moving away, so we are no longer talking about 4. When Jerome Powell suggested the possibility of cutting rates, if it is for July, and then it will be in the middle of the year over and over again. That is in any case maybe 2 rate cuts during this year that we made. So we are seeing how those expectations of an extremely bullish market that appeared on the scene in December last year. Remember when Jerome Powell suggested the possibility of cutting rates, the market we are seeing that the rate cut is being postponed further and further ahead because, as Waller in these speeches we made, said, be careful because the market is discounting in an over-optimistic way target and almost imminent unemployment rate in the United States is below 4%. Was initially discounted. There is no pressure on wages either for that inflation to disappear further and further. So we see that the macro variables from the Federal Reserve said, where is the urgency to cut rates, and the market is suffering as a result. Where is the urgency to cut rates if we are still far from the 2% target, and if the unemployment rate in the United States is below 4%, there is no pressure on wages either, so that inflation is going to disappear. So we see that the macro variables are not in line with this supposed urgency to cut rates, and the market is suffering as a result.
At the moment, these expectations are beginning to cool down. Now we are even talking about May, June, and yet the stock markets have been making maximum after maximum. If this starts to become clearer, if we start to see that there are not going to be cuts, at least in the first half of the year, how will it affect the markets? How is this going to affect the markets, and could there be a significant fall?
Well, the disappointment may come if we have seen that all the rise in the markets in December was motivated by a possible immediate rate cut. If that rate cut does not come, Evidently, the market sees that all that financial aid that was going to enter the interbank system does not appear, and therefore it is obviously disappointed because perhaps it is time to put it another way. And we see this very well in the bonds, in the fixed income market. It is very clear that if interest rates are not going to be cut, it is very clear that it is not going to be cut. It is obviously disappointing because perhaps it is time to put it another way. And we see this very well in bonds. In the fixed income market, it is very clear. If interest rates are not going to be cut as fast as expected, then I have no need to go for the bond that has a yield X, lowering the price of the bond and raising its yield. The investor is looking for a US bond with a good yield as long as he considers that the money in the bank is not going to give him a return. But if the interest rates are going to stay where they are now for a longer period of time, then perhaps I am not so interested in the US bond. And that is why we see that the yields, the bond returns, shoot up just with this data. We see the value of the dollar rising in the future dollar index, the DXY, and we also see bond yields rising, which clearly reflects what at the moment with these two data, just these two movements, we would see that equities will probably tend to turn around and correct a little, simply seeing how fixed income is responding and how the value of money, which is the dollar, is responding.
Well, Gonzalo, we thank you for being with us and above all for shedding a little light on the markets after this data that we see is already beginning to affect the futures. A pleasure as always.
Thank you very much. Thanks to you, my pleasure.